All right, welcome back to Talk Tickers. Today we are digging into a fascinating story from Bank of Marin's Q4 2025 earnings call. Now, on the surface, this thing looked like a total disaster, a massive reported loss. But the stock actually rallied. So what gives? What did the market see that the headlines completely missed? Let's break it all down. So here's how we're going to tackle this. First, we'll hit that earnings snapshot to see what was really going on. Then we'll peel back the layers on that big, scary headline loss to understand why it happened. After that, we'll walk through their pretty brilliant balance sheet reset. And then we'll look at what management is telling us about the future, and we'll wrap it all up with our verdict on what to look for next. Okay, let's start with the numbers that came out of that January 26th call. Because when you first look at them, you see these two figures that seem to be telling completely opposite stories. It's kind of wild. So on a GAAP basis, the official accounting number, the bank posted a pretty big loss of $2.49 per share. Now, for a bank of this size, a number like that, well, it usually sends investors running for the hills. But that's not what happens. Not at all. In fact, BMRC stock closed up almost 4% on the day of the announcement. Which begs the question, right? What is going on here? If the loss was that bad, why on earth were people buying the stock? Well, the answer is right here. It's all about the numbers the smart money was looking at. See, when you strip out all the one-time strategic moves, the bank actually earned 59 cents per share. That absolutely crushed the analyst consensus of 51 cents. We're talking about a 16% beat on the number that shows how the business is really doing day to day. And the good news didn't stop there either. Net revenue also came in stronger than expected. And get this, the bank maintained its dividend for the 83rd consecutive quarter. So from an operational standpoint, this was actually a very, very strong quarter. So let's finally get to the heart of that big negative number, that nearly $40 million net loss. It wasn't some kind of operational failure or a sign that the business is in trouble. No, this was a calculated strategic move, one that was designed to set the bank up for a much more profitable future. And hey, don't just take my word for it. The CEO, Tim Myers, he laid it out perfectly on the call. He basically said, yeah, we took a hit this quarter on purpose so we could supercharge our profitability going forward. It's a classic case of short-term pain for some serious long-term gain. So, how did they actually pull this off? Let's get into the mechanics of this thing. This is where management performed what I can only describe as some brilliant financial surgery on their own balance sheet, all to build a stronger foundation for the years to come. Here's their four-step playbook, and it's pretty slick. First, they unlocked a bunch of older, low-yielding securities. Then, bam, they sold off almost $600 million worth, taking that big one-time loss. But then, they immediately reinvested all that cash into new assets yielding a much healthier 4.26%. And to top it all off, they shored up their capital using debt, which cleverly avoids watering down the value for existing shareholders. Just a really clean, smart move. And here is the immediate payoff. You can see it right here. Net interest margin, or NIM, which is a super important metric for any bank's profitability, jumped by 24 basis points in a single quarter. I mean, that is a massive leap. It just goes to show this strategy started working right out of the gate. All right, so what does this all mean for the future? Well, management was really transparent about what they expect, and frankly, they painted a pretty clear and positive picture for 2026. So, over the next year, they're projecting that this one move alone is going to add about 40 cents to their earnings per share and boost their net interest margin by another 25 basis points. On top of all that, they're seeing solid loan growth, credit quality is getting better, and they feel like they're in a great spot for any potential interest rate cuts from the Fed. And by the way, when you hear that term accretion, it's a really key concept here. It just means a direct, measurable boost to the bottom line earnings for every single shareholder. It's really one of the most powerful ways for a company to create real value. So let's bring it all together. What does this mean for the next earnings call and for the rest of the year? Based on everything we've just walked through, here is our forecast. We fully expect this positive momentum to keep rolling right into the first quarter of 2026. You're going to see the full quarter benefit of that balance sheet reset kick in, which should push adjusted EPS into that 62 to 65 cent range. We also see that NIM expanding a little bit more, though loan growth might be kind of modest just due to some typical seasonal stuff. So what's the big takeaway here? It's that the market was not fooled by that scary headline number. It saw this for exactly what it was, a clearing event. Management basically took their medicine all at once, clearing out the dead wood to pave a clear path to a much more profitable future. So given their decisive, well-executed strategy, the really clear guidance they've provided for earnings growth, and the underlying strength of the business, we're assigning BMRC an outperform rating. And of course, we always have to end with our standard reminder. This analysis is for informational and educational purposes only. This is not financial advice.